it looks like the winds of economic change are a-blowing. In a wild ride with the traders this week, up and down, well actually down and then up. This is the main account, the one we're assuming is money. Now, we went for a wild ride last week. It went below, well, I saw it at 13,000 even, the overall account. Now, I don't check it every day, so I'm not certain how low it might have gone. But then near the end of the week, it started climbing back up again. So we ended up at 14.4 from 14.5. That's pretty much an inconsequential change. So I'm not going to really say anything about that. The overall, so if we go back to the beginning, we're still up. So 12.5 versus 14.4. However, the euro is not up. The euro lost £1,000. And so we went from 13.7 down to 12.7. And overall, the euro has made a loss now because we started at 13.3 and we're now at 12.7. This is normal behavior, unless of course it just drives the value of the account downwards, then it's failed. Okay, the plan is to talk about prices some more. However, before we do that, some news. In the UK, borrowing has hit a record high. This will obviously lead to death and destruction and very, very bad things. And we're going to have to do something immediately. And in fact, if we look back in 2012, we can see an article where Osborne sold his plan for the UK to avoid becoming another Greece. Oh my God. Oh my God. So we need austerity. Lots and lots of austerity. We have not been austere enough. More is needed. We mean cuts. We need cuts and more cuts. Fitch cuts UK's rating on coronavirus debt surge. So this is published in March 2020. Now, what does a rating agency do? A rating agency basically gives indicators to people with money where it's safe to invest it. So a very high rating means a very secure investment. A low rating means a much more risky investment. That's what rating agencies do. That's the whole point. And so here they are downgrading the UK to a AA. Same rating as for Belgium and Czech Republic. The downgrade reflects significant weakening of the public finances, fiscal loosening stance, so basically spending money. And the downgrade also reflects near-term damage to the UK economy, blah. So here's the thing. What has this to do with the ability of the UK to pay back debt? And the answer is nothing. And I'm going to show you why in a second, but I have to say this entire article and the other articles I just showed you are all narrative. It's story. It is unicorns. Let's talk about unicorns and how they impact the economy. One of the key events in history that the austerity hawks invoke is Greece and how Greece basically tanked financially. And they said, as that article I showed you, we don't want UK or the US to look like Greece. We can't have that happen. But here's the thing. The UK has a sovereign currency. The US has a sovereign currency. Greece does not have a sovereign currency. What that means is if Greece runs out of money, they're out of money. There's nothing they can do. That is not true for any country with a sovereign currency, as I'm about to show you.
Where does it come from? Do you just print it?
We print it digitally. So we as a central bank, we have the ability to create money digitally. And we do that by buying treasury bills or bonds or other government guaranteed securities. And that actually increases the money supply. We also print actual currency and we distribute that through the Federal Reserve banks.
Imagine you had a Visa card. And the Visa card was maxed out. And let's say it was an enormous balance. Let's say it was £100,000. And let's pretend you're not a millionaire. So you're not a millionaire, you're a regular person. You have a £100,000 bill. You got 24% interest on the £100,000. That means every year just in interest you owe £24,000. Yeah, that's panic. That's panic. How are you going to pay this off? But you've got an ace in the hole. You have a printing press. Now, if you have a printing press that allows you to legally print money, is that £100,000 bill that you owe with the high interest, is that going to be a problem for you? But Tim, you reject from a university, I hear you say. What about inflation? If the government starts printing money, won't inflation get out of control? Okay, this is going to take a bit longer to explain, but let me just leave you with this at the moment. Let's pretend you are a very lucky person. The government has just printed $100 billion and they give it to you. So you are now $100 billion richer and it's brand new money. Question, is the price of cornflakes about to go up? And you say, oh no, but if it's just me, no, the price of cornflakes won't go up. I'm not going to spend my $100 billion on cornflakes, obviously. But if it gets out there, oh, okay. So let's just say we give it to two people then. We split it. $50 billion to you, $50 billion to someone else. And you both like cornflakes. Is the price of cornflakes going up? Why would you spend more for cornflakes just because you have more money?
We plutocrats need to get this trickle-down economics thing behind us. This idea that the better we do, the better everyone else will do. It's not true. How could it be? I earn 1,000 times the median wage, but I do not buy 1,000 times as much stuff, do I? I actually bought 2 pairs of these pants, what my partner Mike calls my manager pants. I could have bought 2,000 pairs, but what would I do with them? How many haircuts can I get? How often can I go out to dinner?
The distribution of that money counts, and it counts a lot to the prices of all sorts of things. We will be looking at this in depth in the future, but for now, just trust me. If the government prints $100 billion, gives it to you, the price of cornflakes, the price of sugar is not going up. Okay, I want to be very, very clear here. It's really obvious that supply and demand influence price. No disputing that whatsoever. However, that's not what economic theory says. I apologize for shaky cam. I don't have an image stabilizer on this. So if we look at the story, there's a couple of features of the story. One is the market is never wrong. Therefore, if a price is a price, it must be for good societal healthy reasons. The second part of the story is crises and recessions can only happen from market interference. There is no such thing as the market creating a crisis. So basically the story goes like this. You have market, which is perfect. Then you have government, which is imperfect. Government interferes with perfect market. Crisis. What you earn is determined by the market. Whether you have a wage or whether you have an enterprise. No one disputes that. I don't dispute that. However, they also say, say that that wage or that compensation is directly related to how much you've contributed to society. If your wage goes down relative to prices, so if the wage share is dropping, as it has been in the Western countries since the 1970s, then it's the market. And the market is good, and therefore your wage drop is good. Let me just summarize this. Let's just put this into a nutshell. We are told that A, the free market optimizes things for society. We are told B, that prices are, with the exception of frictions, are perfect. Whatever the price is, the market set it, and therefore it is right and good for society. We are told 3, any kind of outside interference with the market will cause inefficiencies and therefore harming society. So where is the evidence for this? What do they claim is the evidence for this? This is the best part. There is no evidence for this. They have a story. Now in science we call that a theory, but it is just a story. And it hinges, the entire story hinges on the fact that supply and demand don't influence price, but supply and demand determine the price. So that if the supply and demand get out of kilter and come back, that price will go back exactly to where it was. Now, if they're wrong, the entire story falls apart. Now, I was born in 1963, and in 1970, there was an oil shock, and the price of gasoline shot up. What I noticed is once everything settled down, the price didn't come back down. And in fact, the oil production by the end of the 1970s per capita was as high as it was before the oil shock. And price still hadn't come down. One of the big discussions going on in the UK right now is the, quote, broken housing market, unquote. And the government has made a number of pledges about trying to build new homes. Now, the reason everyone's so alarmed about our broken housing market is the price of houses. And there it is. It's up 352% since 1952, down here. And this with inflation adjusted. And so here's where it is now. Well, here's where it was in 2015. So, big problem. If you accept that supply and demand must determine price, then there must be a housing shortage. So let's look at the figures now. Again, from around the same time period. Here's the supply. It's gone up 98.8% in the same time span. And these are government figures. So now let's look at the population, which is the demand. Oh, it's only gone up 31.3%. So in other words, housing supply has doubled, whereas the population's only gone up a third. Well, that's interesting. And I'm not the only economist to notice that. Here is this very fine gentleman. How to find a housing shortage in 3 misleading charts. And I will put the link in the description. Okay, what I've just shown you doesn't prove that supply and demand do not determine price. It just shows that it's unlikely. And the problem is, if it doesn't determine price, then all the other things that are claimed about the free market and the well-being of society just fall apart. It's not enough that it influences price. It has to determine price, otherwise you cannot have this ideal distribution that they talk about, and more importantly, you can't have this meritocracy. The evidence suggests to me that price might be determined by something other than just supply and demand. There might be some other more dominant factors involved. But I could be wrong. As a scientist, the goal is to discover what the truth is. What it looks like to me is people have created the free market story or narrative. They've got the whole thing plotted out where everything's wonderful and grand, and then they determine the validity of the evidence by how well it fits with the theory. A scientist really should be doing it the other way around. What I'm going to do in the next video is I'm going to show you some complexity price experiments. So they'll be more like the third video. I'll show you what price looks like when you have multiple agents interacting with each other and emergent behavior is in play. This will be different than the other narrative, the mainstream narrative, because the mainstream narrative in microeconomics, it's 2 agents. By the way, this is an agent. 2 agents interacting. Macroeconomics is 1 agent acting against the economy as a whole. That's the totality of their analysis. And the problem with that analysis is if you've only got 1 or 2 agents, you cannot see how distribution impacts price. It's not possible. The second problem is there's no possibility of emergent behavior. We're going to look at what happens when you bring those things in, and yep, that's it. Well, thank you very much for watching. I hope you found that interesting, and if you have any suggestions, do let me know. Have a good one.